Hello my dear students. The main reason for doing this video is I want to cover few selected important adjustments from different chapters in advanced accounting so that student can revise these important adjustments in a shortest possible time before examination. The duration of this video may be around 1.5 hour to 1 hour 45 minutes. Within that time, I try to explain few key selected important adjustments from 6 chapters. I selected 6 chapters. Financial statements, cash flow statement, amalgamation, consolidation, buyback, internal reconstruction. Within these chapters, I selected few important adjustments according to my personal point of view. I picked up and I try to explain this through this lecture. The main motive is to help the students to revise these concepts before examinations quickly. With that intention only this video has been prepared. So kindly watch it. Thank you. Now let us cover important adjustments from cash flow statement chapter, sir. The first important adjustment is if net profit before tax not given in the question. You know, to arrive cash flow from operating activities under indirect method, we need to start from net profit before tax. But sometimes net profit before tax is not available from the question. They will give you opening balance sheet figures, closing balance sheet figures, and some additional information, but net profit before tax is not available. Then we need to arrive first this net profit before tax to arrive cash flow from operating activities. Right? Now, how to arrive net profit in this case? First, take the closing P&L account balance, then reduce opening P&L balance. The difference is nothing but current year net profit after appropriations from current year net profit. Add back what are all the appropriations you have done from the current year net profit. Generally from the current year net profit, what kind of appropriations we will do? 3 kind of appropriations are generally they will do. First, provision for tax. Another one is dividend, either interim or final dividend. Next, transfer to general reserve. If any one of these appropriations happened from the current year, add back to this difference. You will get net profit before tax. Now that will be the starting point. Then you can continue and ascertain the cash flow from operating activities. So how to ascertain net profit before tax? First start with the closing P&L, reduce opening P&L balance. Then the difference is nothing but current year net profit after appropriations from current year profits. Then add back the appropriations you have done from the current year profits like provision for tax, transfer to general reserve, dividend, adjustment. You will get net profit before tax. I will show you one question, sir. Question number 18. Rain limited sum. In this sum, we need to ascertain cash flow statement under indirect method. First, we are going to start with cash flow from operating activities, right? So we want net profit before tax, but net profit before tax is not available in this question. So first to go to reserves and surplus, see the P&L account. P&L account opening balance 50,000, closing 1 lakh. The difference is nothing but 50,000. What is this? This is 50,000. Difference between opening and P&L, opening P&L, closing P&L balance is current year profit after appropriations. So add back the appropriations, you will get net profit before tax of the current year. What appropriations might happen? Maybe transfer to general reserve. Check it. Opening general reserve 2,50,000, closing 1.5. That means nothing has been transferred to general reserve during the year. So ignore. Next to provision for tax. Any provision for tax happened from the current year? Current year profits. If you look at the additional information, 6th point, they have given income tax liability for the current year, 1,35,000. That means this liability of the current year, provision is created from the current year profits obviously. So 1,35,000 is an appropriation happened from current year net profit. So add back to that difference 50,000. And also you see 5th point, interim dividend was declared and paid during the year. So obviously dividend is declared from the profits, current year profits. So this is also one of the appropriations. So add back. So in this case, take the difference between P&L account 50,000. For that, current year tax liability add back, interim dividend add back. You will get net profit before tax. You look at the solution. See this. First we start with net profit before tax. How we got this net profit before tax? So this. First we take the closing balance of P&L 1 lakh minus opening balance 50,000. Provision for tax, that is current year tax liability given in the question 1,35,000. Interim dividend 90,000. So 2,75,000 is the net profit before tax, which is the starting point to arrive cash flow from operating activity. Okay. And also I will show you one more question, sir. Question number 19. new light limited question. In this question also same thing, sir. We need to ascertain cash flow statement under indirect method. So first we will start with the net profit before tax. But we don't know net profit before tax. So we know the opening P&L balance 2,40,000, closing 3,40,000. So the difference is how much? 1 lakh. Now to this 1 lakh we need to add back the appropriations from current year profits. What appropriations might be done? General reserve. See, this 6 has become 7.6. That means 1,60,000 may be appropriated from current year profit. So add back. Next, to provision for tax. If you look at the additional information, sir, provision for tax is not given in the question. Current year provision for tax. But if you look at the balance sheet, liability side, provision for tax given opening 3.6, closing 3.4. Next, I am going to explain the tax adjustment, sir. Only in the question, provision for tax opening and closing balance given, sir. The assumption is whatever the opening provision is there, it is paid during the year. Whatever the closing provision is there, it is nothing but provision for tax appropriated from the current year profits. So therefore, from current year profits, 3.4 lakhs is appropriated. So therefore, we need to add 3.4. So in this question, to ascertain net profit before tax, the difference between the P&L accounts, that is 1 lakh. For this, we need to add a transfer to general reserve 1.6 lakhs, and we need to add a closing provision for tax 3.4 lakhs. So you will get net profit before. Okay, I will show you, sir. So question number 19. See this. In this question number 19, first we need to start with net profit before tax. How we arrived this net profit before tax? See this. Closing balance 3.4, opening balance 2.64. Actually, to the opening balance, one more adjustment done, sir. That adjustment I am going to cover it later. But see, provision for tax transfer to general reserve. Two things have been added. So you will get net profit before tax. So this is the first adjustment, ascertaining net profit before tax. Refer question number 18 and 19. Next, sir, tax adjustment, sir. Sir, in indirect method, sir, tax adjustment is one of the predominant adjustments. In case of tax adjustment, sir, there are three possibilities are there. First case number 1, sir. In the question, they will give you only opening and closing provision for tax. That's it. No other information is available, sir. Just now we have seen in this question number 19, provision for tax, opening 3.6, closing 3.4 given, sir. No other information is available in respect of tax. If this is the case, sir, what we need to do is whatever the opening provision is there, it is assumed paid during the year. Therefore, tax paid during the year is 3.6. Okay, which we will consider in cash flow from operating activities. This 3.4, whatever is there at the end of the year, it is nothing but provision for tax of the current year. So when you are ascertaining net profit before tax, if it is not given in the question, you need to add back current year provision for tax, in this case 3.4. So if you look at the solution, see this, to ascertain net profit before tax, we have added 3.4 lakhs. And also I will show you, to ascertain cash flow from operating activities, what is the income tax paid we have taken? 3.6, that is opening provision. So this is the treatment. This is the first case, sir. So only if opening and closing provision for tax is given as, sir, opening provision assumed it is paid during the year. Closing provision is nothing but provision for tax of the current year. If net profit before tax is not given, so to arrive it, add back. Now sometimes in the question, they will give you opening provision, closing provision, at the same time current year tax liability also they will give. So opening provision, suppose 5 lakhs given, sir. Closing provision 7 lakhs given. And at the same time they said in the additional information that in the current year the tax liability is 5 lakhs. So you know the opening provision, you know the current year tax liability, you know the closing provision. The difference is nothing but tax paid during the year. Tax paid during the year. So therefore in this case, opening 5, current year provision 5. So 5 plus 5, 10. Closing 7 minus 7. So 3 lakhs is what, sir? Tax paid during there. Tax paid we will consider in operating activities. Okay. And also this current year tax liability is nothing but what, sir? Current year provision for tax appropriated from current year profits. So therefore when you are arriving net profit before tax, if it is not given in the question, we need to add back provision for tax, no, sir, to this difference. So this provision for tax is nothing but this current year tax liability of 5 lakhs. Okay, this 5 lakhs. See, exactly, sir. In this case, reflecting in question number 18, sir. If you look at question number 18, in this question, in the balance sheet, short-term provisions, you see opening provision 60, closing 95. In the additional information, they have given current year income tax liability 1,35,000. Now, in this case, what we need to do, I will show you. How to arrive tax paid. In this case, see this. In this case, first you consider opening 60, current year tax liability 135, so 1,95,000, closing 95. That means tax paid 1 lakh. So when you are ascertaining cash flow from operating activities, tax paid 1 lakh will be considered. And when you are ascertaining net profit before tax, so you need to add back current year tax liability 1,35,000. So very simple. Opening, closing, current year tax liability. Then tax paid is the balancing figure. So in this case, opening 60, closing 95, current year tax liability 1,35,000. So 60 plus 1,35,000, 1,95,000 minus closing 95. Therefore, 1 lakh is tax paid, which we consider in cash flow statement operating activity. And when you are ascertaining net profit before tax, whatever the provision created from current year profits, that is 135, which will be added back. Okay. This is second case, sir. Now, third case is they will give you opening provision for tax, closing provision for tax, sir. They will give you tax paid also. So, opening, closing, tax paid. Then balance figure is what? Nothing but current year provision for tax. So, when they give tax paid, na sir, directly consider in cash flow statement operating activities, income tax paid. Of course, it's the cash outflow. Now, in this case, you see, opening provision 5, closing 7, paid 3. So, balance figure is nothing but provision created from the current year profits. So, when you want to ascertain the cash flow from, when you want to ascertain the net profit before tax, if it is not given in the question, we need to add back provision for tax. In this case, what is the current year provision for tax? We ascertain 5 lakhs. We need to add back. So 3 cases, very simple cases. Only opening, closing provision given. Opening provision assumed paid. Closing provision is nothing but current year provision for tax. Appropriated from current year. While arriving net profit, it is not given, add back. Opening given, closing given, current year tax liability also given. Then ascertain the balancing figure. Opening plus current year minus closing is nothing but tax paid during the year, which we consider in cash flow statement operating activity. When you are ascertaining net profit before tax, if it is not given in the question, add back provision for tax. Whatever current year tax liability is there, now add back. Suppose opening given, closing given, tax paid given. If it is given, directly consider in operating activity. And the balance figure is nothing but current year provision for tax. When net profit before tax is not available in indirect method, you want to find out cash flow from operating activities. For that, this provision for tax you should add back. And there is one more adjustment, sir. In one of the question, I think illustration number 10 in the study material, if you see, they have given tax liability as well as advance tax. I will show you, sir. One question is there. Question number, illustration number 10. Yeah, this illustration, sir, illustration number 10. In this illustration, if you see, sir, they have given opening provision for tax 180, advance tax 180. Opening provision as well as advance tax, both will be adjusted, na, sir. So advance tax is my current asset, which I paid for tax only. So therefore, both will be adjusted. Now, whatever the advance tax is there at the end, 195, this 195 is nothing but tax paid during the year. This 200 is nothing but provision for tax created from the current year. So therefore, while arriving net profit, you add back this 200 and tax paid you consider 195. Now in this case, you see tax paid 195 they have considered, right? Okay. So in this case, whatever the opening advance tax is there, which is adjusted to opening provision for tax. Whatever the advance tax during the 15 lakhs is there, it is nothing but tax paid during the year, which we consider in operating activities. So this is the second adjustment, sir, stock adjustment. Now tax adjustment, sir. This is tax adjustment we have completed. Now next one, stock adjustment, sir. Sir, what is this stock adjustment? Listen to me carefully, sir. Very, very important. Sir, suppose your opening stock is 90 given, sir. Your closing stock is 2 lakhs given. This company has the policy of valuing the stock at cost less 10%, sir. But now they want to follow the correct policy, that is the valuing inventory at cost. And this closing stock 2 lakhs they have correctly given, but opening stock they have not given correctly. Now this is at cost less 10%. Suppose if this is also correctly valued, what will be my closing stock balance? 1 lakh. 10,000 will be increased because this is at 90. If I make it at 100, it will be 1 lakh, right? So if my opening stock balance increases by 10,000, obviously this opening stock is last year closing stock. So if my last year closing stock increases by 10,000, last year net profit would also increase by 10,000. Therefore, what I need to do is, in the question, if they have given any adjustment relating to stock and they said that stock was undervalued opening, now what you need to do is, in that question, suppose you need to ascertain net profit before tax. Suppose net profit before tax not given in the question. What we need to do? Closing P&L balance minus opening P&L balance. When you are minusing the opening P&L account balance, you know last year stock was undervalued. Now if I make a proper valuation, my profit would also be increased. In this case, if my stock is properly valued, it has been increased by 10,000. Therefore, my P&L account balance will also increase by 10,000. So therefore, do opening P&L balance, you add this 10,000. Suppose in the question, they have given a closing P&L balance of 50,000. Opening P&L balance originally given 10. But stock was wrongly valued. If I make a correct valuation, my opening P&L would be 20,000. So that is what I need to do. So important adjustment. So then it will become 30,000. So therefore, when you are preparing cash flow statement under indirect method, first you need to start from net profit before tax while arriving cash flow from operating activities. To arriving this net profit before tax, this stock adjustment is very, very important. If the opening stock is not properly valued, means if it is properly valued, definitely stock value will increase. Opening stock increases means opening P&L balance will also increase. So therefore, I need to increase my opening balance to the extent of increase in stock. And then again, when you are ascertaining cash flow from operating activities under indirect method, working capital changes we will adjust now. That means the difference between current assets and current liabilities. Now since here my opening stock now correctly valued at 1 lakh, my closing 2 lakhs inventory, so the difference 1 lakh I will adjust as working capital changes to ascertain the cash flow from operating activities. Okay, so I will show you this question also, sir. One question, I think question number 19, sir. New Light Limited question. In this question, if you observe, sir, last point they have given one adjustment relating to stock. See, this company decided to value the inventory at cost, whereas previous practice was to value the inventory at cost less 10%. Now the inventory according to the books on 31st March 2010 was 2,16,000. The inventory on 31st March 2011 was correctly valued at 3 lakhs. That means closing inventory properly valued, but opening inventory undervalued. Now if I make a proper valuation, this 2,16,000 is at 90. I need to increase another 10%. So it will be 24,000. So therefore, if I increase my opening stock by 24,000, my opening P&L account balance will also increase by 24,000. So therefore, what I need to do? 24,000. So my opening P&L account balance is 2,40,000 plus 24. It will be 2,64,000. 2,64,000 minus 3,40,000. So 76,000 I need to consider as the difference between closing and P&L, opening P&L. For this, I need to add back the appropriations to arrive net profit before tax. I will show you in this question, question number 19. Yeah, in this question, sir, you see. So when you are ascertaining the net profit before tax, to this opening balance, see this original P&L balance 2,40,000, we add 24. Why we add 24,000? See this increase in the opening inventory. If I make the valuation at cost 24,000, so if my opening stock increases, my opening P&L account balance will also increase by 24. So therefore it will be 2,64,000. This is the first adjustment. And later on, sir, when I'm ascertaining cash flow from operating activities, say this, the increase in other current assets, working capital changes. So this 11,34,000 I consider, sir, this 11,34,000 includes that 24,000 also. That increase in opening balance. Sir, the difference between opening and closing inventory is nothing but changes in working capital, right? So therefore the 24,000 also I need to add back to my opening current assets. So that is the second adjustment. Okay, so this is one adjustment, sir. Look at question number 19. Next, dividend adjustment, sir. Suppose in the question, sir, they have given you dividend, opening balance given, closing nothing given. That means it is paid during the year. Dividend paid is which activity? Financing activity, you consider it. And sir, you receive any dividend. See, generally receiving dividend is what? Investing activity. When you receive any dividend, it's the investing activity. And when you are receiving dividends, sir, irrespective of the nature, whether it is pre-acquisition or post-acquisition, doesn't matter, sir. Whatever you can consider in the cash flow statement, because in case of pre-acquisition dividends, sir, generally it is adjusted to cost of investment, like that they will give, but doesn't matter, sir, whether it is pre now post or doesn't matter, you can consider it in cash flow statement as investing activity. And one more adjustment is PPE given at cost, sir, provision for depreciation given separately. Sir, when asset is given at cost, provision for depreciation given separately, try to prepare different ledger accounts, because the main purpose of preparing PPE account is to ascertain the balancing figure. The balancing figure most of the cases is additions during the year, which will come in investing activity. And try to prepare provision for depreciation account. Most of the cases, the main purpose of preparing provision for depreciation is to ascertain the depreciation. Depreciation is a non-cash item. You know, in indirect method, when I want to ascertain cash flow from operating activities to the net profit, I need to add back these non-cash items, right? So sometimes they won't give you depreciation. But in the question, provision for depreciation is available. Therefore, try to prepare provision for depreciation to ascertain the depreciation of the current year as the balancing figure. Suppose if in the question current year depreciation is given, no need to prepare provision for depreciation account. Suppose in this question, you see, I have taken PPE at cost 32. Opening. Provision for depreciation 9.2. Closing 38. Provision for depreciation 11.6. Now during the year, what happened? They have sold some PPE. Sale value 1 lakh, cost 2 lakhs, provision for depreciation 80,000. Now in this case, what is the entry we will write, sir? Whenever there is a sale, bank account debit 1 lakh. And when I sold a part of PPE, I need to cancel provision for depreciation relating to it. So provision for depreciation 80,000. To PPE, what is the cost of PPE? 2 lakhs. Sir, when you are maintaining asset at cost, whenever you sold the asset, reduce the asset balance by its cost, 2 lakhs. So therefore 2 lakhs is the cost, sir. Accumulated depreciation 80. That means 1.2 lakhs is the WDV, and you are selling at 1 lakh. Therefore, what is the loss? 20,000, which is debited to P&L account. Now, when I prepare PPE account, I will consider opening balance, I will consider closing balance, and this entry I will write. In the PPE account, credit side by bank 1 lakh, by provision for depreciation 0.8, by P&L account 0.2. Now the PPE account must tally. If it is not tallying, debit side there is a balance of 8 lakhs. Generally asset side debit balance means what? This is nothing but purchases, additions during the year, which will come in investing activity. Mainly the purpose of preparing PPE account is to ascertain this as a balancing figure. Please see it. And one more thing, sir. From this ledger account, you can make some proper analysis to ascertain the cash flow from operating activities. Like for example, there is a sale of fixed asset. Sale of fixed asset comes in investing activity, one thing. Second, there is a loss on sale of PP. Sir, this loss on sale of PP is debited to P&L account. So when you are ascertaining cash flow from operating activities under indirect method, this 0.2 lakhs, what we need to do, it is already adjusted to net profit. So we need to add back in cash flow from operating activities. And when I prepare provision for depreciation, sir, my opening provision 9.2 I considered, my closing 11.6. And the asset which I sold, in respect of which the provision cancelled 0.8. So therefore the difference is current year depreciation. When I'm maintaining depreciation separate, provision for depreciation separately, what is the entry for current year depreciation, sir? Nothing but depreciation to provision for depreciation, 3.2. In the question, suppose if this is not available, we need to consider, we need to calculate, because when we are ascertaining cash flow from operating activities and indirect method to the net profit, this depreciation is already adjusted now. So we need to add back this. So for this, I think better you solve question number 19, sir, because this question is having proper adjustments relating to PPE and also investments. So if you prepare them, then you will get the more clarity. So these are some of the important adjustments which you are going to refer before exams relating to cash flow statement. Now let us cover important adjustments from amalgamation chapter, sir. The first important adjustment is calculation of PC, especially under net assets method. How to calculate PC under net assets method? Agreed value of assets taken over minus agreed value of liabilities taken over. agreed value is the important thing, sir. If agreed value is not given, then we may consider book value. Now the most important question is, sir, when I need to follow net assets method for calculation of PC? Sir, if based on the information given in the question, if you are unable to ascertain any one single mode of PC, then that's an indication that you can follow net assets method. Suppose, sir, problem number 22, you see, in this question, Y Limited is taking over X Limited, sir. So Y Limited has to pay PC to X Limited. In point number 3, they are talking about PC, sir. The purchase consideration is to be paid in cash to the extent of 3 lakhs. Very clear. And the balance in fully paid equity shares of 100 each at 125 per share. So they are saying that cash will be given 3 lakhs. Balance will be given in the form of equity shares. 100 rupees share they will give at 125. But for what amount? Are you able to quantify the amount in the form of equity shares? Here, no. You know the mode, but you don't know the amount. For what amount I am going to issue equity shares? I know I am going to issue equity shares of 100 each at 125 per share, but for what amount? We don't know. Therefore, here in this case, we will follow net assets method to calculate the PC. And when you are calculating net assets, PC under net assets method, consider agreed value if it is given. If not given, book value. So in this case, PC is 6,05,000, sir. And this 6,05,000, how they are going to discharge? Cash 3 lakhs clearly given. Balance 3,05,000 will be given in the form of equity shares. So from 6,05,000 minus 3 lakhs, if I do 3,05,000 is the mode of PC in the form of equity shares. Now each share is given at 125. So 3,05,000 divided by 125. So 2,440 equity shares will be given. I will also show you one more example, sir. Illustration number 7, like that one illustration is there. Yeah, this illustration, sir. K Limited, L Limited question, sir. K Limited, L Limited is taken over by LK Limited, sir. Now LK Limited is paying purchase consideration to the shareholders of K and L. If you read this question carefully, sir, how many preference shares will be given, at what price it will be given, how many equity shares will be given, at what price it is given, clearly mentioned. But in addition, they have used one word. In addition, necessary cash would be paid to the equity shareholders of both the companies. LK Limited said to the K Limited, L Limited shareholders that, equity shareholders that, you are going to get equity shares. Along with the equity shares, necessary cash will also be paid. But what is necessary cash here? We don't know. We are unable to quantify. So here also we need to follow net assets method to calculate the PC. So the first important thing when you are reading the question, amalgamation sum, so whether based on the information available in the question, am I able to calculate PC or not? If you are unable to quantify the PC based on the information, then understand this is a net assets method. So I need to find out the net assets of the transferor company, that is agreed value of assets taken minus agreed value of liabilities taken. Okay, that is the first important adjustment. Next, liquidation expenses is another important item, sir. Very simple only. See, as far as the liquidation expenses or realization expenses at the time of amalgamation, 3 cases will come. First, liquidation expenses incurred by transferor himself, liquidation expenses incurred by transferee. Third, sometimes liquidation expenses incurred by transferor but reimbursed by transferee company. Suppose liquidation expenses incurred by transferor himself, realization to cash or bank. In the books of transferor, transferee books, no entry will be recorded. Suppose if liquidation expenses incurred by transferee, then transferor books, no entry will be recorded. In transferee books, what entry you will write? If it is a purchase method, you know, in transferee books, purchase method, pooling of interest method. If it is a purchase method, sir, these expenses will be adjusted to goodwill or capital reserve. Goodwill or capital reserve to cash or bank. Now, if it is a pooling of interest method, we will adjust it to free reserves. I mean, general reserve or P&L account data to cash or bank. Now, third case, the most important case, sir. Sometimes liquidation expenses incurred by transferor, but transferee promised to the transferor that you incur, I am going to reimburse to you. So therefore, as a transfer company, I know when I am incurring liquidation expenses, these expenses are going to be reimbursed by transferee company. So when I am incurring these expenses, I will debit transferee company. So transferee account debtor to cash or bank. And later on, when they reimbursed cash or bank account debtor to transferee, I will write. So what is the difference between case 2 and case 3? No difference. Here directly incurred by transferee, here indirectly incurred by transferee. Net effect is nil. But when it comes to transferee, in the third case, so they know when transferor company incurred the expenses, we are going to reimburse them. So therefore, transferor company we will credit in our books and debit will be given to goodwill or capital reserve if it is a purchase method. If it is a pooling of interest method, instead of goodwill or capital reserve, we will give credit to general reserve or P&L account will be debited. And when we actually reimburse, transfer our company account debtor to cash or bank. Okay. So this is liquidation expenses adjustments. Now, the third important adjustment when you are doing amalgamation is incorporation entry. That too, especially in the books of transferee books, very, very important. Sir, when you are writing journal entries in the books of transferee, what are all the assets and liabilities which is coming from transfer you need to incorporate. Now, if the amalgamation is in the nature of purchase, if it is a purchase method, how to incorporate? What assets you are taking, what liabilities you are taking, you incorporate in your books. Only the assets and liabilities taken over. That too at what value you are taking, agreed value. So various assets taken over at agreed value will be debited. Various liabilities taken over at agreed value will be credited. And that means assets minus liabilities, net assets. Compare with the purchase consideration, business purchase. Now, in this case, if net assets PC, we make a comparison. If the PC paid is more than net assets, that will be loss to us. Loss will be treated as goodwill. If the PC paid is, less than the net assets, that means less than the worth of business we are taking, it's kind of a profit to us. It will be transferred to capital reserve. This is amalgamation in the nature of purchase method. And in pooling of interest method, sir, we will take all assets, all liabilities, including reserves from the transfer company, that too at book values. So therefore, what are all the assets, their book value, what are the liabilities of transfer, book value, reserves and surplus, and PC, business purchase. Now, in pooling of interest method, sir, as a transferee company, what is the PC I am paying? I will compare with the worth of business I am taking from transfer. Here, what is the worth of business I am taking? Exactly equal to share capital of transfer company. Because in the balance sheet of transfer company, you see assets will be there, liabilities will be there, share capital will be there. So I am taking share capital and reserves and surplus will be there. I am taking assets, I am taking liabilities, I am taking reserves and surplus also. So therefore, what is the amount left out is exactly equal to share capital. Now, so why we waste our time in calculation? Simply, we will compare PC with the share capital of transfer company. If our PC is more than the share capital, that's a loss for us. Now, AS14 says, if at all there is a loss in case of pooling of interest method, that loss first adjusted against the free reserves of transfer company. If not available, free reserves of transferee company. If that is also not available, then it will be adjusted to, it will be debited to the P&L account of transferee company. So this is one of the most important adjustments. We will see some questions relating to this. Illustration number 8 and 9, sir. You know, illustration number 8, sir. Actually, this illustration, they have asked both the cases, amalgamation in the nature of merger as well as purchase. Both the cases they have asked, sir. Now, illustration 8, suppose if it is amalgamation in the nature of merger, sir. You know, transferee company incorporated all assets of transfer company. What are all the assets are there? X Limited is transferee, sir. So in Y Limited, what are all the assets are there? All assets we will incorporate in our books. All liabilities we will incorporate in our books. See this, all assets, all liabilities, including statutory reserves. See, in the books of transfer company, there are some statutory reserves. Like for example, in this question, you see export profit reserve, investment allowance reserve. These are also taken over. See this, because this is amalgamation in the nature of merger. Everything will be taken over. And if it is a pooling of interest method, I told you, PC we are paying 5,370. We need to compare with share capital of transfer company. What is the share capital of transfer company? 4,700. Because that is the exactly worth of business we are taking. That means our PC is more than share capital, 670 loss. Now what we need to do, I told you, this loss first adjust against the free reserves of transfer company. What are the free reserves of transfer company? General reserve is there 250, adjust. Next P&L account is there 500, adjust. So see this 670 loss, first we adjust against free reserves of transfer company, general reserve 250, not sufficient. Then we adjust against P&L account. So this is how the incorporation will be done. Now from the 500 P&L account, if I adjust 420, only 80 will be incorporated. This is incorporation in case of pooling of interest method, sir. Suppose the same amalgamation in the nature of purchase, we don't incorporate any kind of reserves and surplus. Here we compare PC with the net assets taken over. The difference will be either goodwill or capital reserve. In this case, capital reserve. Okay. Okay. And also, sir, I will show you one more question. Now see illustration number 9, sir. Illustration number 9, sir. In this question, P Limited is taking over Q Limited, sir. And in the question clearly mentioned, sir, inventory in trade debtors are taken over at 5% less than the book value. 5% less than book value. So therefore, when you are writing the incorporation entry in the books of transferee, see this. Inventories are taken at 95%. Debtor also 1,90,000 and provision, this 5% they have created a provision separately, or else you can directly reduce from debtors. And also in these questions are one more important thing, debentures of Q Limited are paid at 8% premium. So therefore even debentures also we will incorporate in our books as a transferee, whatever the debentures are there in transfer, we will incorporate at 8% premium. So this, because we have taken debentures at 8% premium. So therefore 1,50,000 plus 8%, 1,62,000. So therefore if it is amalgamation in the nature of purchase or merger, you have to carefully see whether it is purchase method or pooling of interest method. If it is a purchase method, agreed values. If it is a pooling of interest method, book values. If it is a purchase method, PC compared with net assets. If it is a pooling of interest method, PC compared with share capital of transfer. Here loss is goodwill in purchase method. Profit is capital reserve. In pooling of interest method, loss is adjusted against free reserves of transfer if available. Not available, against free reserves of transferee. That is also not available, debit to P&L. Okay, so this is incorporation entry, important adjustments. Illustration 8, 9 you have to see. Next, sir, one more important adjustment is sale or purchase of goods between transferor and transferee before amalgamation. Sir, before amalgamation, between companies, transactions might happen. Sale and purchase of goods might happen. Okay. Now, see, for example, A Limited is there. It sold some goods to B Limited. Before amalgamation, 1 lakh worth of goods sold at 20% profit. 1 lakh cost, 20% profit added, 1,20,000 is the sale value. Now imagine, this is the thing happened before amalgamation. Now A Limited is transferee company, sir. B Limited is transferor company. Now that means B Limited business is taken over by A Limited, right? Now A and B becoming now, part of one entity only. Before amalgamation, there are two entities. Now after amalgamation, only A Limited will remain. B Limited will be merged into A Limited. Okay. So A Limited knows that in B Limited there is some stock which is nothing but sold by me. I sold these goods at a 20% profit. Now out of the stock which is sold by A Limited, sir, in B Limited 60,000 remains unsold. So therefore what A Limited will need to do, sir? In this 60,000, whatever the profit unrealized will eliminate, because this stock still not yet sold, na sir. So in this stock, whatever the profit is there, it is not yet realized, na sir. So if the stock profit is not realized, we will eliminate. So at the time of amalgamation, in A Limited books, we need to eliminate whatever the URP, unrealized balance, unrealized profit is there in this stock, we need to eliminate. Sir, how much is the unrealized profit, sir? 10,000, because 20% is the profit, right? 1,20,000, 1,20,000 is the total value. In that 60,000 remaining. So 10,000 is the unrealized profit. See this. So this 60,000, how we are going to eliminate? See this. When A Limited is taking over B Limited, we will write incorporation entry, right? At the time of incorporation entry, if you write the stock of B Limited at 60,000, you suppose what are all the assets coming from transfer, we will write in transferee books. So A Limited books, we will write stock 60,000. Okay. Later on, you eliminate the unrealized profit separately by writing a separate entry. What is the entry I will write, sir? To eliminate this, simple. If it is purchase method, goodwill or capital reserve to stock reserve account. If it is pooling of interest method, general reserve or P&L account debtor to stock reserve account. 10,000, 10,000, you eliminate. Okay. Or else, what we can do is, at the time of incorporation itself, we will eliminate URP. That means we will take the stock at 60 minus 10, 50,000. That means at the time of incorporation entry itself, if you incorporate this stock, at 50,000, eliminating unrealized profit, automatically it is adjusted to goodwill or capital reserve. No need to adjust separately. No need to write this separate adjustment entry. So therefore, very simple, sir. When transferee company sold goods to transferor company before amalgamation, now both the companies are amalgamating with each other. Whatever the stock is there in transferor company, right? That in that stock, whatever the unrealized profit is there, that unrealized profit we need to eliminate because that profit is not relevant for us. It is not yet realized. Therefore, when we take over the stock of transferor company, at the time of takeover itself, if you eliminate it, no need to write separate elimination entry. Suppose if you incorporate the stock at original value, I mean 60,000, then you write a separate entry to eliminate the unrealized profit. And also when you are preparing balance sheet after amalgamation, so you take the stock of transferee as well as transferor company. So transferor company stock 60, URP 10, take 50,000 only. Okay, very simple. Sir, what happens if transferor company sold goods to transferee company? When transferor company sold goods to transferee company, the stock is there with whom? Transferee. Therefore, transferee company will eliminate unrealized profit which is included in its, right? So most important thing is who sold goods to whom. If transferee sold goods to transferor before amalgamation, now transferor company assets are my assets including stock. Now that stock is coming into my books, so I will incorporate at its original value. If I incorporate at 60,000 including unrealized profit, I will eliminate this unrealized profit separately. Or at the time of incorporation itself, if I remove this unrealized profit, then automatically it will be adjusted in the goodwill or capital reserve. Okay, no need to eliminate separately. And when I'm preparing the balance sheet after amalgamation, I will adjust this stock reserve. So this is one important adjustment, sir. I will show you one question, sir. Now see question number 22, sir. In this question, sir, Y Limited is taking over X Limited, sir. Now, here one point given, sir. Y Limited sold prior to 31st March 2011 goods costing 60,000 to X Limited for 80,000. That means transferee company before amalgamation, they sold 60,000 cost of goods at 80,000, sir. 50,000 worth of goods still in the inventory of X Limited on 31st March 2011. Now look at this. That means before amalgamation, transferee company sold goods to transferor company. 60,000 worth of goods are sold at 80,000. That means 20,000 is the profit. Out of the stock which is sold, still 50,000 worth of stock is goods remain with transferor company, that is X Limited. Now tell me, at the time of amalgamation, what you are going to do? Simple. In this 50,000, whatever the unrealized profit is there, we will eliminate in the books of transferee company. Because this 50,000 stock as a transferee company, we will take from transferor company, right? Now, but important thing is that when you are taking the stock of transferor company, if you are taking the stock below the cost, then automatically some unrealized profit is eliminated. Only remaining unrealized profit we need to eliminate. So I will show you. See in this question, see this. Y Limited is a transferee company, sold goods to X Limited, transferor company. See in this case, this is transferee. This is transferor. Before amalgamation, there was a sale. 60,000 cost of goods, they sold at 80,000. And out of that, 50,000 remains unsold. That means this stock is not yet sold to the customers. That means whatever the profit included in that stock is not yet realized. So what is the unrealized profit first of all included in this? So unrealized profit is equal to total profit is nothing but 20,000, sir. So 20,000 is for 80,000 sale value, 50,000 still remaining. Therefore 12,500 is what, sir? 12,500 is unrealized profit including that 50,000. Now in the question clearly mentioned that Y Limited will take over all assets of X Limited cost plus 10%, sir. See this. Y Limited, yeah, take over the assets less than 10%. Less 10%. That means when they are taking the inventory, sir, 50,000, 10% less they have taken. That means 5,000 already deducted. That means when you are incorporating itself, you will incorporate it 45,000 only. That means 5,000 already eliminated. Therefore, out of this 12,500 of unrealized profit, 5,000 is already eliminated. At the time of incorporation itself, we reduce to 10%. Therefore, balance to be eliminated only 7,500. So that we will eliminate. For that, we will write a entry in the books of transferee company. What is the entry we will write? If it is amalgamation in the nature of purchase, we will write goodwill or capital reserve to stock reserve account. Okay. And now this 7,500 we will remove from the inventory also when we are preparing the balance sheet of the company. So very simple. When transferee company sold goods to transferor company, Now that stock is coming to us at the time of incorporation itself. If you remove some of the unrealized profit, only balance you need to remove now. Okay. So this is one important adjustment, sir. Then statutory reserves. Sir, in the transferor company, if there are any statutory reserves is there, those statutory reserves not required to incorporate separately if the amalgamation is in the nature of merger. Because in merger, pooling of interest method, we will take all assets liabilities including reserves. But in purchase method, generally transferor company reserves we will not take over as a transferee company. But these are statutory reserves which is required to be maintained as per law for some more period of time. So being a transferee company, it is now my responsibility to maintain these reserves. Suppose there is a reserve in B Limited, export profit reserve, which is a statutory reserve which is required to be maintained for another 3 years. Now imagine A Limited is taking over B Limited. Now A Limited has to incorporate the statutory reserves in its books. See, I need to incorporate the reserves of transferor company, but my reserve should not get affected by it. So how can I do that? By creating a dummy reserve. So therefore, amalgamation adjustment reserve account data to statutory reserves I will do. And once the period is over, I will reverse this. Okay. And one more thing is intercompany transactions. Sir, between A Limited and B Limited, suppose example, transferee and transferor, before amalgamation, there might be some transactions happen. And there must be some mutual debts or owings are there. For example, A Limited has given a loan to B Limited. So A Limited books you see loan given, asset. B Limited books you see loan taken, liability. Now I am transferee company. I have taken over B Limited. Now from B Limited, while incorporating, I will write loan taken 10 lakhs as a liability. And later on, I came to know that I know that this liability is nothing but against my asset only. So my asset loan given, the liability I have taken over, both I will cancel it because now these two become one entity only. Okay. So these are some of the important adjustments from amalgamation chapter. Now let us cover important adjustment from consolidation chapter, sir. Now before discussing the important adjustments, you should have the basic idea about the consolidation procedure, the steps involved in it, especially step number 3, analysis of subsidiary company reserves and surplus, apportionment of the analyzed profits, ascertaining minority interest, calculation of cost of control, thereby goodwill or capital reserve, intercompany transactions, identification of intercompany transactions and calculation of reserves for consolidated balance sheet. See, these are some of the key steps involved in consolidation procedure, sir. Out of these steps, maybe steps like minority interest or maybe cost of control can be asked as a separate small questions. Now let us discuss the important adjustments. When you are analyzing the subsidiary company reserves and surplus, sir, the first thing you need to consider is revaluation of assets in the subsidiary company. When parent company acquiring subsidiary company, sir, if any of the assets of the subsidiary company are not at their proper value, what parent company will do is they will revalue the assets of the subsidiary company. If any assets of the subsidiary company are revalued on the date of acquisition, so whatever the profit or loss arises from because of the revaluation, treat it as a pre-acquisition profit and treat it as a capital profit. That is the first thing you need to consider. Second impact is because of the revaluation, either assets value may increase or decrease. Because of the increase, additional depreciation may come. So it is going to impact the post-acquisition profits of the subsidiary company. That we need to consider. Similarly, when there is a decrease in the value of the asset, whatever the excess depreciation you provide, you need to return back. Because of that, my post-acquisition profits means subsidiary company post-acquisition profits might get affected. That also we need to consider. For example, see this, there is a company S Limited, sir, subsidiary company. This subsidiary company acquired by parent company on 1/4/2024. Now on the date of acquisition, the machinery book value is 1 lakh. Revalued amount is 1,50,000. That means how much increase? 50,000. That is revaluation profit. Furniture 20,000, sir, revalued to 15,000. That means there is a revaluation loss. So overall 45,000 is the revaluation profit, which will be treated as pre-acquisition profit and treated as capital profit. That is the first adjustment. Now because of this revaluation, what happened? Machinery value increases, furniture value decreases. If machinery value increases by 50,000, on that additional depreciation of 10% will come. So 5,000 will be the additional depreciation, which is going to reduce my current year profits. That is post-acquisition profits. Okay. So in the question, suppose they have given P&L account, closing balance 25,000, opening balance 15, entire opening balance pre-acquisition profits. So current year profit is 10,000. So from this current year profit, I need to reduce additional depreciation because of the revaluation. Similarly, furniture, we provided depreciation on 20,000 book value, but we need to provide depreciation on 15,000. Therefore, whatever the excess depreciation we provided on 5,000, that is 750, 5,000 into 15%, 750, we need to return it back so that our profits will be increased to that extent. So therefore, our revised current year profit is 5,750, which is a post-acquisition profit, which is treated as a revenue. So this is the most important adjustment when you are analyzing the subsidiary company reserves and surplus, if at all there is a revaluation of assets. So simple thing is, two things you need to consider. One is any revaluation profit or loss, pre-acquisition profits, capital profits. Second, because of the revaluation, it is going to impact my post-acquisition profits. Additional depreciation or excess depreciation provided will be returned back. Now the second important adjustment when you are analyzing the subsidiary company reserves and surplus is dividend given by subsidiary company. Sir, when dividend given by subsidiary company, sir, obviously subsidiary company profits will reduce. So that's why this is very much relevant when you are analyzing the subsidiary company reserves and surplus. Understand? When subsidiary company gives any dividend, whatever the share of the parent company in that dividend, what parent company will do? That depends upon which source of profits the subsidiary company utilizes to pay this dividend. If the dividend is given by the subsidiary company from pre-acquisition profits, now the share of dividend which is received by the parent from the pre-acquisition profits will be treated as capital profits. It is adjusted to the cost of investment. One thing. If the dividend is given by the subsidiary company from post-acquisition profits, now that share of dividend which is received by the parent company from the post-acquisition profits of subsidiary, that will be treated as revenue profit and that will be credited to P&L account. Therefore, whenever any dividend given by the subsidiary company, which source the dividend came, pre na post. If it is pre, adjust to the cost of investment. That means step number 6, cost of control. When you are doing cost of control step, okay, from the amount of investment, whatever the pre-acquisition dividend we received from subsidiary company, we will adjust. Okay. Now see this. I have given one example also. Suppose subsidiary company S Limited, sir. Parent company acquired the subsidiary company on 1st November 2024. That means first 7 months pre, next 5 months post. Total 5,000 shares are in subsidiary company. Parent company acquired 3,000 shares. That means 60% shares. Opening P&L account balance 2,50,000 in the subsidiary. Current year profits 3 lakhs. Now subsidiary company declare a dividend for the year ending 31st March 2025 at the rate of 40%. Now the total equity share capital is 5 lakhs, sir. On that 40% means 2 lakhs is the total dividend given by subsidiary. In this 2 lakhs, parent company share 60%. That means 1.2 lakhs. Now when parent company doing consolidation of subsidiary, this 1.2 lakhs dividend, what is the treatment? Very simple. This 1.2 lakhs came from which source? Is it pre or post? If this 1.2 lakhs is given by subsidiary company from pre-acquisition profits, then adjusted the cost of investment. If it is given from post-acquisition profits, then it is transferred to P&L account, credited to P&L account like a normal revenue income. Suppose here, two cases I have assumed. One, suppose profit for the year 24-25 is utilized to pay the dividend. Sir, current year 24-25 profits were utilized, sir. Sir, in the entire current year, first 7 months pre, sir, next 5 months only post. Therefore, if the profits are earned evenly throughout the year, out of the total 12 months profits, first 7 months is pre, sir. Therefore, out of this 1,20,000, 7 months, if I apportion according to the time, 1,20,000 into 7 by 12, 70,000 is received from pre-acquisition profits, which I adjusted to the cost of investment. Out of this 1,20,000, 5 months, which is post-acquisition profit, which I credited to P&L account, because it is my revenue profit. This is my capital profit. 7:5. Suppose, sir, if I assume the entire dividend is given from the last year profits, profit of the last year is utilized to pay the dividend. Suppose last year profit is 2,50,000. Now this entire dividend of 1.2 lakhs is given from the last year profits. Entire last year profits are pre-acquisition profits. Therefore, entire dividend what you receive adjusted to the cost of investment. Adjusted to the cost of investment. Okay, very simple. Now see this question, sir. Question number 10, sir. Now in this case, parent company H Limited, sir, acquired subsidiary company S Limited on 31st March 2010. Sorry, date of acquisition is 31st March 2010. Now if you observe B point, on 1st April 2010, S Limited declared a dividend at 20% for the year ending 31st March 2010. last year, dividend relating to the last year is declared on 1st April 2010, sir. Now tell me, sir, as a parent company, I acquired subsidiary on 31st March 2010. That means literally I don't have any shares in the last year. Relating to the last year, subsidiary company is giving dividend on 1st April 2010. So definitely which profits they are going to utilize to give me the dividend? Pre-acquisition profits. Now this pre-acquisition profits from where I have received the dividend, I need to adjust to my cost of investment. But what H Limited is done, see this. H Limited created the dividend received by H to P&L account. That is wrong treatment they have done. So sometimes what they will give is parent company received a dividend from subsidiary company from pre-acquisition profits. But what parent company has to done is they need to adjust to the cost of investment, but they created a P&L account. Now they need to rectify this. So how to rectify it? Simple. When you are preparing reserves for consolidated balance sheet, so from the P&L account of the parent company, reduce this pre-acquisition dividend which is already created. First thing. Second, when you are preparing cost of control step, in step number 6, from the investment value, you reduce this pre-acquisition dividend, because this is what exactly we need to do. We need to adjust to the cost of investment. So see this. In this question, while preparing cost of control from the cost of investment, see this. Parent company share in the dividend, pre-acquisition dividend reduced. And also when I am preparing step number 6, reserves for consolidated balance sheet, first I consider the balance sheet balances of parent limited, P&L account 2715. In this P&L account, there is a pre-acquisition dividend wrongly created. I deducted it. Because in this question, sir, dividend received from pre-acquisition profits, but they have wrongly created to P&L account. That we need to rectify. So that is what I have given as a 6th. See this. Dividend received from pre-acquisition profits of subsidiary, but wrongly created to P&L account. Now when you are preparing the reserves for consolidated balance sheet, take the P&L account balance of the parent company. From that, this pre-acquisition dividend you reduce. And the actual treatment is when you are preparing cost of control, from the cost of investment, you reduce this pre-acquisition dividend, because it's a recovery of cost. Okay. So therefore, ultimately the dividend treatment, whenever dividend is given by the subsidiary company, the dividend treatment depends on what? Dividend is given from which source? Pre, post. Pre means adjust to cost of investment. Post means created to P&L account. Sometimes parent company receiving dividend from subsidiary from pre-acquisition profits, but they wrongly created to P&L account. Now you need to rectify it. So in step number 8, when you are preparing reserves for consolidated balance sheet, minus from the P&L account of the subsidiary parent company. And in step number 6, cost of control, deduct from the cost of investment. Next, one more important step when you are doing consolidation is upstream downstream transactions. Upstream downstream transactions. Sir, when you are doing consolidation, intercompany transaction, one step is there. Step number 7. Step number 7. In that, this point, assets comprising goods or machinery purchased from another company. Okay. First, upstream downstream transactions we are going to discuss, sir. Listen to me carefully. Sir, there is a parent company, there is a subsidiary company. Parent company selling goods to subsidiary. That means goods are flowing from parent to subsidiary. So this is called what? Downstream transaction. This is downstream transaction. Suppose, sir, subsidiary sold goods to parent company. That means goods is flowing from subsidiary to parent. So this is called upward transactions. So when goods are flowed from parent to subsidiary, it's a downstream transaction. When goods are moved from subsidiary to parent, it's an upward transaction, upstream transaction. Okay. Suppose if there is a downstream transaction, that means parent company selling goods to subsidiary company. Suppose the goods are sold at cost plus 10%. Suppose cost is 10 lakhs, 10% profit added, 11 lakhs. Suppose the entire stock is there in the subsidiary company, entire stock is not yet sold. Now tell me, you are preparing consolidated balance sheet. Consolidated balance sheet means parent and subsidiary is treated as one entity. Now whatever the stock is there, 11 lakhs. In this stock, how much is the unrealized profit? 1 lakh, which is not yet sold. So group point of view, if you see, when parent and subsidiary become one entity, whether this 1 lakh without realizing, without selling to anybody, can you recognize this as a profit? No. So therefore from this stock, we need to eliminate it. So already see, these goods are actually sold by whom? Parent. Therefore, from the parent company profits, whatever the unrealized profit is there in step number 8, reserve for consolidated balance sheet, entire 1 lakh will be eliminated. So therefore, when you are preparing reserves for consolidated balance sheet, parent company P&L account, you eliminate this unrealized profit because it is not yet realized. So not relevant for consolidated financial statements. And also when you are preparing the consolidated balance sheet, you need to consider the stock value. Parent company stock, add subsidiary company stock. But when you are adding the subsidiary company stock, eliminate this 1 lakh unrealized profit and then add. You consider only 10 lakhs. So you understand the treatment of downstream transaction. When parent company sold goods to subsidiary company, out of the goods sold, whatever the unsold stock is there, in that unsold stock, whatever the unrealized profit is there, that you need to eliminate at the time of consolidation. From where I need to eliminate? If goods are sold by parent to subsidiary, that profit is there in the parent company P&L account. Therefore, in step number 8, reserves for consolidated balance sheet, you eliminate this URP. And also, when you are preparing consolidated balance sheet, you consider the stock amounts. Parent company stock plus subsidiary company stock. When you are adding subsidiary company stock, in that subsidiary company stock, you know there is an unrealized profit that you eliminate. Consider only the cost part. Sir, suppose if subsidiary sold goods to parent, then important. Sir, suppose sir, subsidiary company selling goods to parent, cost plus 10%. Cost is 10 lakhs, 10% profit, that is 11 lakhs is the sale value. Now important, listen to me carefully. Sir, when subsidiary sold goods to parent, now the profit is recognized by whom? Subsidiary. Subsidiary has recognized the profit. Now subsidiary company profits are already analyzed and apportioned between the parent and minority interest. That means including this 1 lakh profit, unrealized profit, which is already apportioned, analyzed and apportioned between the parent and subsidiary, parent and minority interest. So what you need to do is, you need to eliminate. So out of this 1 lakh profit, unrealized profit, what is the parent company share? Suppose parent company share is 60%. 60% eliminate from the parent company profits. 40% eliminate from the minority interest. You understanding the logic? Very simple, sir. When you are analyzing the subsidiary company reserves and surplus, this profit is also analyzed now. Suppose for example, subsidiary sold goods to parent. Suppose entire stock is unsold on the date of consolidation. So on this stock, what is the unrealized profit? 1 lakh. So this 1 lakh profit is already there in whose books? Subsidiary books. Now this profit already we analyzed. Analyzed and apportioned between the parent and minority interest. Therefore, you eliminate from both the places. So from minority interest, we have a separate step. So from minority interest, eliminate unrealized profit. Their share, 1 lakh into 40%. When you are from the parent company, reserves for consolidated balance sheet, take the parent company P&L account. In that URP, you eliminate parent company share. And when you are preparing consolidated balance sheet, when you consider the stock amount, parent company stock plus subsidiary company stock. When you consider the subsidiary company stock, you eliminate this unrealized profit and consider. Okay. Now see this question, sir. Question number 10. In this question, sir, on 31st March 2011, S Limited inventory, that means subsidiary company inventory included goods which it had purchased for 100 lakhs from H Limited, which made a profit of 25% on cost. That means here who sold goods to whom, sir? Parent sold goods to subsidiary. So parent company sold goods to subsidiary, sir. See this, H Limited sold goods to S Limited at cost plus 25% profit. So the sale value is 100 lakhs, sir. So what is the profit which is recognized by H Limited, sir? 25% profit on cost, sir. So 1/4 on cost, 1/5 on sale price. So 100 lakhs. Say this. 100 lakhs is included in subsidiary company. In this 100 lakhs, what is the unrealized profit? 20 lakhs unrealized profit. This unrealized profit we need to eliminate from parent company completely. Because here the transaction is what? Downstream transaction. Entire 20 lakhs is eliminated from the parent company reserves and surplus. I will show you. See this. Reserves for consolidated balance sheet. Unrealized profit on sale to subsidiary company 20. Eliminate. Okay. So this is another important adjustments. So whenever you are doing consolidation, if there is any transactions taken place between the parent and subsidiary, you see whether the transaction is downstream or upstream. Downstream means parent selling goods to subsidiary company. When parent sold goods to subsidiary, out of the goods, whatever the unsold stock is there, in that unsold stock, whatever the unrealized profit is there, that unrealized profit at the time of consolidation you eliminate. So since goods are sold by parent company, 100% unrealized profit is eliminated from the parent company profits. So step number 8, reserves for consolidated balance sheet, unrealized profit you eliminate. Now suppose if the subsidiary company sold goods to parent company, now the profit is there in the books of subsidiary. Now whatever the realized profit is there, that's okay. See, when parent sold goods to subsidiary or subsidiary goods sold to parent, whatever the unsold stock is there, we are talking about only the unrealized profit. Unrealized profit means whatever the profit included in the unsold stock. Whatever the stock sold now, the profit will be realized. So we are not bothered about. So if you see from the group point of view, if the stock is there within the group, the profit is not yet realized. So therefore, in case of upstream transaction, the profit which is unrealized, it is already there in the subsidiary company, and that profit was analyzed and apportioned between the parent and minority interest. So therefore, reduce from minority interest in step number 5, I think, minority interest step, as well as step number 8, reserves for consolidated balance sheet. See this. That's why in minority interest, less stock reserve, it is applicable only in case of upstream, I told you. And when you are preparing reserves for consolidated balance sheet, see this. Reserves for reserves for unrealized profit. So we eliminated from step number 8, that is parent company share in the unrealized profits in case of upstream transactions. Okay. This is one adjustment, sir. Next adjustment is minority interest, sir. So when we prepare consolidated balance sheet, you know minority interest we will show separately on equity and liability side. So minority interest will always show credit balance, sir. Minority interest is basically nothing but what, sir? In the subsidiary company, whatever the net assets are there, suppose 100 is there. In this net assets, what is the share of minority shareholders? Suppose parent company is having 80%, minority interest is 20%. But parent company at the time of consolidation doing 100% consolidation. That means entire net assets of the subsidiary company they are incorporating. They know out of this some portion belongs to minority shareholders, 20. So they will write this 20 as kind of a liability, equity and liability side, minority interest. But this minority interest can have a debit balance. It is like amount to be recovered from the minority shareholders. No. So the standard says whenever minority interest, as long as it is having a credit balance, you show. Once it becomes a debit balance, minority interest, because of the subsidiary company losses, then you adjust the minority shareholders share in the losses of the subsidiary company to the parent company reserves. Once the subsidiary company started earning profits, in whatever the adjustment done to the parent company reserves, you reverse it back. Okay. So minority interest can never show debit balance, sir. That's the bottom line. I will show you one question, sir. So this question, yes, illustration number 4. Now in this question, they are asking us to calculate minority interest. This is a favorite, examiner's favorite question, sir. A Limited acquiring B Limited 70% shares, sir. That 30% is the minority interest. At the time of acquisition, sir, subsidiary company is having reserves and surplus. But next 4 years, they suffered losses, sir. Next 3 years, they earned profits, sir. Now in this case, how to calculate the minority interest? Simple. See this. First, beginning of the year, on the date of acquisition, that is on 1/4/2011, when parent company acquired subsidiary company, they acquired 70%. On that date, equity share capital 10 lakhs, reserves and surplus 80, total 10.8. In this 10.8, minority shareholder share is 30%. Therefore, minority interest at the beginning is how much? 3,24,000. Minority interest on the date of acquisition 3,24,000. Now in the year 11-12, you see there is a profit. There is a loss of 2.5. So in this loss, what is the share of the minority shareholders? 75,000. 2,50,000 into 30%. 75,000 loss. So that means minority interest balance adjusted to 2,49,000. So closing minority interest balance, credit balance, which is shown in the consolidated balance sheet, 2,49,000. Next year also there is a loss, 4 lakhs loss. In this 4 lakhs, 30% share, 1,20,000. So 2,49,000 minus 1,20,000. So minority interest has become 1,29,000 credit balance in the balance sheet. Again next year there is a loss, sir, 5 lakhs. In this 5 lakhs, their share is 30%. 5 lakhs into 30%. It will be 1,50,000. But you see, from the subsidiary company, our share of loss is 1.5, but minority interest is showing only credit balance of 1,29,000. Therefore, here the minority interest is becoming debit balance, right? What standard says is, do one thing, 1,59,000, but the credit balance is 1,29,000. Adjust entire 1,29,000. Whatever the excess is there, please adjust to the parent company reserves. So 21,000 adjusted to parent company reserves. So therefore, in the consolidated balance sheet at the end, the minority interest will become negative, and the adjusted reserves of parent company will become 21,000. That means 21,000 will be adjusted to the parent company reserves. 21,000. That means minority interest can never be shown as debit balance. Next year also, suppose loss, our share 30, next year again there is a loss, I think 1.2 lakhs. In this 1.2 lakhs, 30%, 36,000. Again, this will be adjusted to the parent company reserves. So total 57,000 is adjusted to parent company reserves. Next year 15-16 there is a profit. See this. There is a turnaround and they earned a profit of 50,000. In this 50,000, the share is 30%. So 15,000. So when again subsidiary companies start earning profit, whatever the minority shareholders share, previously the excess is adjusted to the parent company reserves, right? Now you adjust it back to this 15,000 adjusted to the 57,000. Now the adjusted reserves of parent will become 42. Again next year there is a profit 1 lakh. In this 30%, 30,000. Again adjusted to 42,000. Now the adjusted reserves of the parent company will become 12. And finally in the year 17-18, 1,50,000 profit in the subsidiary. In this 30% share, 45,000. Now this, see this. From this 45, the adjusted balance 12,000 and remaining 33,000. Again, the minority interest has become a credit balance, 33. So therefore, the bottom line is minority interest cannot show debit balance as it is irrevocable. So therefore, being a parent entity, at the time of consolidation, I am doing 100% consolidation of the entire subsidiary company, but I know certain portion belongs to minority shareholders. So therefore, whatever the portion belong to minority shareholders, I will show it as on the liability side, being a credit balance. Suppose if the subsidiary company is suffering losses, because of that minority interest may become debit, but we cannot show debit balance of minority interest. The moment minority interest is becoming debit, the whatever the loss that adjusts to the parent company reserves. When subsidiary again start earning profits, we adjust to the reserves already adjusted, right? So this is the sum, sir. Very good sum. Please solve this sum. And different accounting policies. See, in our material, sir, there is one question relating to it. See, whenever you are doing consolidation of the parent and subsidiary, sir, make sure that they will have the same accounting policies. If the policies are different, what we need to do is, first a subsidiary company, we need to change the financial statements of the subsidiary company in accordance with the parent company accounting policies. Then only it will be considered for consolidation. Okay. Now, illustration 16, sir, this question, they have given subsidiary company balance sheet, sir. And this subsidiary company balance sheet, it is not following the accounting policies in accordance with the subsidiary parent company. Therefore, in this question, what we need to do is, first we need to convert the subsidiary company financial statement as per the accounting policies of the parent company. Then only we need to consider the subsidiary company for consolidation purpose. Okay. So that's why they are asking, restate the balance sheet of B Limited, that is subsidiary company, after considering the above information for the purpose of consolidation. Would restatement be necessary to make the accounting policies adopted by A Limited and B Limited uniform? Yes. So whenever you are doing consolidation, if the subsidiary company accounting policies are not in accordance with the parent company accounting policies, first you need to convert the financial statements of the parent subsidiary into parent and then consider it for consolidation. Okay. So these are the important adjustments. Sixth one I already covered. These are few important adjustments in consolidation chapters. Now let us discuss the important adjustments from financial statements of company chapter, sir. I'm going to explain the important adjustments from problems. Now see first illustration number 1, sir. Illustration number 1 is about dividend from past profits. Whenever company wants to give any dividend by using past profits, there are some important rules. First rule is the rate of dividend cannot exceed the average of the last 3 years. Second, the amount to be withdrawn from the past profits cannot exceed 1/10 of the paid up capital plus free reserves. Next, last one is the balance in reserves after such withdrawal shall not fall below 15% of the paid up share capital. These are the three major rules. Now, apart from this, if there are any current year losses, first we need to adjust the losses, then only the balance will be utilized for payment of dividend. Now in this illustration one, sir, company does not have adequate profits in the current year, but still company wants to pay dividend of 10% by using general reserve. Now they are asking how much amount they can withdraw from general reserve by following the rules. Now in this case, company is having preference share capital 17 lakh 50. Whenever we have preference share capital, first from the available profits, preference dividend will be paid. Then only the balance profit will be used for payment of equity dividend. So our current year profit is 3 lakhs. So 17 lakh 50,000 into 9%. So 1 lakh 57,500 is the preference dividend. So from this 3 lakhs, first I need to pay 1 lakh 57,500. So the balance available is 1 lakh 42,500. But company wants to pay 10% dividend on equity shares. So 80 lakhs into 10%, 8 lakhs. So 8 lakhs will be the equity dividend, but the profits available is 1 lakh 42,500. Therefore 6 lakhs 57,500 is what company wants to take from general reserve. But is it allowed? Apply. First condition, the rate cannot exceed last 3 years average. Last 3 years average is 12%, but company wants to pay 10%. Therefore condition number 1 is satisfied. Second, the amount to be withdrawn from general reserve cannot exceed 1/10 of the paid up capital plus free reserves. Your paid up capital is 97 lakh 50 and your free reserves is 25 lakhs. Capital reserve, revaluation reserve is not free reserves. So therefore on this 10%, sir, it will be 12 lakh 25, but we want to withdraw 6 lakh 57,500. Therefore this is within the limits. Condition number 2 is satisfied. Condition number 3, sir, the balance in reserves after such withdrawal shall not fall below 15% of the paid up share capital. Your paid up share capital is 97 lakh 50. If I apply 15% on this, it will be 14 lakh 62,500. And from 25 lakhs, if I withdraw 6 lakhs 57,500, the balance in reserves is 18 lakh 42,500, which is way more than 15% of paid up share capital. Therefore, condition number 3 is also satisfied. Since all the conditions are satisfied, company can withdraw 6 lakhs 57,500. Next, if you see illustration number 2, sir, in this question, plant and machinery is given at cost, provision for depreciation given separately. That means we will maintain the asset at original cost and depreciation we will transfer to a separate account called provision for depreciation account. And in this question they have given a suspense account also. What is this suspense account? Suspense account, they are saying that is nothing but sale of some of the machinery. They sold some of the machinery for 4,000. And this sale of machinery, the cost of the machinery sold is 10,000. Accumulated depreciation thereon is 8,000. Now, whenever the cost of the asset and provision for depreciation given separately, sir, we need to adjustment also will be done separately for the cost as well as provision for depreciation. Now, in this case, what is the entry company will write? Cash or bank account debit 4,000, accumulated depreciation or provision for depreciation account 8,000. Because whenever an asset is sold, sir, the corresponding depreciation against which is also cancelled. So, provision for depreciation account debit 8,000. To plant and machinery 10,000, to P&L account, that is profit on sale of machinery 2,000. So here the profit is 2,000 which will be transferred to P&L account. Bank account 4,000, accumulated depreciation cancelled 8,000, plant and machinery 10,000. So therefore when you prepare balance sheet, sir, see here plant and machinery, the opening balance of plant and machinery given 770, sir, see this 770. And from this 770 at the beginning, 10,000 worth of plant and machinery was sold. So minus 10, so 760. From that, I need to less provision for depreciation. But because in the balance sheet, sir, whenever you are presenting assets, sir, cost minus provision for depreciation. This provision for depreciation they have already given in the trial balance. This is 172. This is opening provision. Now for this, you need to make the current year adjustments. So current year adjustments are what? Current year depreciation is 10% on 760, 76 minus 8. 8 minus is what? The depreciation in respect of assets sold. Therefore, the closing provision for depreciation is 240. So, plant and machinery will be shown at 520. Okay. And there is one more important point in the question, sir. Interim dividend paid. Interim dividend paid means it is not a liability. Paid means it is not a liability. But whenever a company paid any dividend, sir, that has to be adjusted to reserves and surplus. See this. When you are preparing reserves and surplus P&L account, so from the profits they have reduced this interim dividend. So understand this point also. And one more important point, sir, this one. Declared dividend on 2nd April. Sir, whenever any company declares any dividend after 31st March, don't consider this as a liability because there is no obligation on the balance sheet date. So this is one point, sir. So final dividend shall not be recognized as a liability because it is not a liability as per accounting standard. So this is problem number 2, important adjustment, sir. Next, coming to problem number 4, sir. Illustration number 4, International Hotels Limited. See, in this question, sir, these hotels, sometimes when you are preparing the financial statement, sir, you need to see the nature of business also. Now, for a hotel, see, in this question, the main adjustment is what? Inventory adjustment. Now, think from hotel point of view. Hotel is selling wines, cigarettes, cigars. Now, this is what? This is stock in trade because hotels are not manufacturing this wines, cigarettes, cigars. They are purchasing and selling to the customers. So this is stock in trade. Now relating to stock in trade, what items we will show? As per schedule 3, when you are preparing P&L account, expenses side, relating to stock in trade, you need to show two things. One is purchase of stock in trade. Another one is change in inventories of stock in trade. So these purchases we need to show separately. And also difference between the opening and closing, we need to show separately. I will show you. See this, when you are preparing this purchase of stock in trade, see 45,800. What is this 45,800? This one. And the difference between the opening and closing, that is shown as change in inventories of stock in trade. So the presentation, see this, opening balance of wine, cigarette, cigars, closing balance of wines and cigarette, cigars, 9,700. And see, there is one more thing, sir, food stuff. What is this food stuff? See, hotel will purchase food ingredients to prepare the food. Now those are called what? Raw material for the hotel. Now in respect of raw material, as per schedule 3, what items we need to present? Consumption we need to present. Therefore, whenever you are preparing financial statements, in respect of food stuff, you need to show consumption. So say this, cost of materials consumed, we need to show separately. Understand the presentation aspect of what? Raw material here in this case. Stock, how they are going to be presented in the financial statement. Cost of materials consumed. Cost of materials consumed is nothing but what? Food stuff. How to find out consumption? Opening plus purchases minus closing. Okay. So this is one important adjustment, sir. Now apart from this, sir, one more adjustment, sir. In this question, if you see, in the opening 1st April 2011, this company share capital is 7,20,000, sir. 6,000 shares fully paid, sir. 2,000 shares 60 paid. And they made a call of 40 per share on 1st October. A shareholder could not pay the call on 100 shares and his shares were forfeited and reissued at 90 per share. Now important. Shares forfeited and reissued. Already 100 shares, we received how much, sir? 60 rupees already received. 40 rupees not received. And they have reissued. The reissued price is 90. That means this 90 plus already 60. Total 150 rupees we got it. But to the share capital, obviously only face value will be transferred. Therefore, the extra 50 rupees we received in respect of the forfeited shares, 50 into 100, 5,000, it will be transferred to capital reserve account. But in this question, what they have done is, they have included it as a part of share capital. So therefore, we need to remove from the equity share capital and we need to show as a part of capital reserve. This is important adjustment here. So when you are presenting reserves and surplus, see this, capital reserve 5,000. So this is illustration number 4, important adjustments. Next, next, sir, illustration number 5 is one of the very important questions, sir. In this question, you see additional information, sir. 2,000 shares were issued for consideration other than cash. Whenever any shares are issued for consideration other than cash, as per schedule 3, we need to present we need to present it separately in the notes to accounts. In the notes to accounts, we need to present this separately. Whenever any company issued any shares, see this, any shares are issued for consideration other than cash. Look at when you are presenting share capital, equity share capital issued, subscribed, called up, and less call scenario. See this, out of the above 2000 shares were issued for consideration other than cash. This is a requirement as per schedule 3. So understand, this is one of the important requirement. And also in this question, sir, trade receivables 52,000 due for more than 6 months. You know, according to schedule 3, we need to prepare debtors aging schedule. When debtors are outstanding for a period of more than 6 months, we need to show separately. So that's why here in this question, when you are presenting debtors, see this, trade receivables outstanding for a period exceeding 6 months, show separately in the notes to accounts. Other debtors show separately. That is one important adjustment. And also, sir, in this question, sir, there is a loan from State Financial Corporation. See this, 1,50,000 loan is there. This 1,50,000 includes interest accrued but not due, 7,500. Now, according to schedule 3, sir, whenever, interest accrued but not due will be shown as a part of other current liabilities. So therefore, from this 1,50,000, what we need to do is 7,500 we need to show as a part of other current liabilities. Only balance 1,42,500 will be shown as a part of long-term borrowings. This is one important adjustment. And also, sir, this loan is secured by hypothecation of plant and machinery. See, according to schedule 3, sir, whenever any borrowings are secured, we need to mention the nature of security. So that's why here, see, I am presenting long-term borrowings. There I am presenting secured by hypothecation of plant and machinery. See, these are very, very small points, but very, very important, which will give you marks. Next, sir, any fixed assets held for sale. When fixed assets are held for sale, where will you show? Current assets. They will be shown as a part of current assets. The definition of current asset and current liabilities. Anything held for sale in the ordinary course of the business is a current asset. Next, current maturities of long-term debt as per schedule 3. Current maturities of long-term debt will be shown as a part of, so short-term borrowings. Understand, very, very important. Short-term borrowings. Short-term borrowings. Don't show it as other current liabilities. Next, sir, some important items where they were going to be presented. Share application money received in excess of issued share capital. In excess of issued share capital, if company received anything, that will be that amount we need to refund to the shareholders. That amount will be refunded back to the applicants, right? So this will be shown as a part of other current liabilities. Next, share option outstanding account generally will be shown as a part of reserves and surplus. Next, unpaid mature debentures, other current liability. Now this one is very, very important, sir. Uncalled liability on shares and other partly paid investments. See, the moment you see uncalled liability on shares, most of the students are thinking it is call scenarios. No, see, this is uncalled liability on shares and other partly paid investments. Your company or your business has made an investment. In respect of that investment, if that other company where you invested, if they call now, you need to pay. That is called uncalled liability on shares and other partly paid investments. Now, that will be part of your commitment. So, that will be shown as a part of contingent liabilities and commitments. Suppose I invested in 10,000 shares of other company, 5 rupees paid, remaining 5 rupees when they call I will pay. So that is called commitment. Okay. Next. That's it, sir. This is the first chapter, financial statements of company, important points, sir. And if I go to the schedule 3, what are the important points I can see? Schedule 3. First, share capital. Sir, whenever you are presenting share capital, sir, remember, if any shareholder is holding more than 5% shares, we need to mention how many shares he is having, what is the name. And most important thing, if any company has issued shares for consideration other than cash, or if any company issued fully paid up bonus shares, or if any company bought back any shares, if any one of these things happen, for a period of 5 years, company need to disclose the aggregate number class of shares. And when it comes to reserves and surplus, sir, even P&L account debit balance also we need to show as a part of reserves and surplus only. Okay. And then current maturities of long-term borrowings, I told you we need to show as a part of what? Short-term borrowings. Next, current liabilities, other current liabilities. Current maturities of finance lease obligation. If it is finance lease, in respect of the finance lease obligation, if there is any current maturities, that will be part of other current liabilities. Interest accrued but not due, interest accrued and due, any income received in advance, any unpaid dividends, any application money received for allotment of securities and which is due for refund, and interest accrued thereon, any unpaid mature deposits and interest accrued thereon, unpaid mature debentures and interest accrued thereon, they are all part of other current liabilities. Next, whenever you are presenting trade receivables, see, relating to trade receivables, sir, we need to prepare an aging schedule. This aging schedule is generally classified into undisputed, considered good, undisputed but considered doubtful, disputed but considered good, disputed, considered doubtful. So remember this classification relating to trade receivables. And when it comes to the outstanding period, less than 6 months, 6 to 1 year, 1 to 2 years, 2 to 3, more than 3. So this is the aging schedule. According to that, you need to classify the debtors. Now commitments, I told you, na sir, any unpaid, uncalled liability on partly paid up shares and other investments. Remember this item, this will be called as commitment. And when you are preparing the schedule 3, as per schedule 3, if you are preparing P&L account, expenses side, cost of materials consumed. This cost of material consumed is the respect of raw material. Purchase of stock in trade. When you have any stock in trade means you purchase and sell. You don't manufacture. That will be in respect of stock in trade. We need to show purchases separately, change in stock in trade separately. That International Hotels Limited, some we have seen a hotel, wines, cigarettes, cigars. We show purchases separately, change in inventories of stock in trade separately. If it is the raw material, we will show consumption. In that some food stuff we have shown consumption. Okay. And then, and remember this point, sir, any item exceeding 1% of revenue or 1 lakh, disclose it separately. Any item exceeding 1% of revenue or 1 lakh, disclose it separately as per schedule 3. And also some practical questions relating to schedule 3, sir. In this, suppose a company has given a bonus shares, sir, 24,000 bonus shares of 10 each. But they have not mentioned the source from which this bonus shares have been issued. Is it a violation? Not a violation. So just now I told, as per schedule 3, whenever a company issued bonus shares, they need to mention aggregate number, class of shares. No need to mention the source. So it is not a violation. And second one, sir, this company, what they have done is, they have some work in progress, sir. Opening work in progress, closing work in progress, more or less the same. So they don't want to show, work in progress separately. Opening work in progress, closing work in progress, they don't want to show separately. Is it violation of schedule 3? No, because as per schedule 3, will you require to show work in progress separately? Just now I told you, in P&L account, when you are preparing P&L account, sir, expenses, cost of material consumed, purchase of stock in trade, change in inventories of finished goods, work in progress. In respect of work in progress, only opening and closing we will show separately, right? So therefore no company is required to show opening separately, closing separately. Only change is sufficient. And in this problem, practical number, question number 3, this company is having a loss of 250 lakhs in P&L account and they want to show this an asset side. Is it correct? No. As per schedule 3, if your P&L account is having a loss balance, then also it has to be shown under the head reserves and surplus with a negative balance. And this question is relating to classification of liabilities, sir. Just now I told you, sir, any current maturities of long-term debt will be classified as short-term borrowings, not other current liabilities. These things you see, debtors aging schedule and all. Debtors aging schedule, when you are preparing, you remember this: undisputed, considered good; undisputed, considered doubtful; disputed, considered good; disputed, doubtful. And this period less than 6 months, 6 to 1, 1 to 2, 2 to 3, more than 3. So this one you need to remember. And whenever company gives any dividend from the past profits, what are the rules we need to follow? I told you. That's it. This is financial statements of company, important points. Now let us cover buyback of securities, sir. In buyback of securities, the important points or adjustments are: first, sources of buyback. There are 3 sources available, sir. Free reserve, securities premium, proceeds from fresh issue of shares. And the limits for buyback. Whenever a company wants to go for buyback of securities, what is the maximum number of shares a company can buy back? Here 3 tests we will apply, sir. Least of the above 3 will be the maximum number of shares to be bought back. First one is shares outstanding test. The maximum number of equity shares bought back cannot exceed 25% of the total paid up equity share capital of that financial year. Resource test. The maximum amount that can be used for buyback cannot exceed 25% of the paid up capital plus free resource. Here free resource including securities premium we need to consider. And debt equity ratio test, sir. After buyback, make sure that the debt equity ratio should be maintained in 2:1 ratio. It cannot exceed 2:1. Here debt means both secured plus unsecured. Equity means paid up share capital plus free resource including securities premium. And creation of CRR, sir. Sir, whenever a company depends upon free resource or securities premium for buyback of securities, then to the extent of the nominal value of shares of bought back, they must transfer from free resource to CRR. So creation of CRR, to ensure capital intactness and to protect the interest of the creditors, especially at the time of buyback, is also very, very important. And then accounting entries. So whenever there is a buyback of securities, first buyback, then shares bought back will be cancelled. Then whatever the premium on buyback is there, that will be adjusted against free reserves or securities premium. And finally transfer to CRR. These 4 entries will come. First, buyback. Whenever there is a buyback, what is the entry? Equity share buyback account debtor to cash or bank account. Next, cancellation of bought back shares. Whatever the shares we bought back, sir, we will cancel them. Whenever we cancel any bought back shares, equity share capital account debit, premium on buyback account debit to equity share buyback account. See, this premium on buyback. Generally, when we purchase any shares above the face value, that is premium on buyback. So then this premium will be adjusted against securities premium or free reserves and transferred to CRR. Whenever we depend upon the free reserves or securities premium for buyback of securities, then to the extent of the nominal value of shares of bought back, we must transfer from free reserves to CRR and make sure that only fully paid up shares are bought back and cancelled. So these are the entries. Now I am going to cover one important question, sir. The important question which is covering all the important adjustments from this chapter. Question number 8. So in this question, sir, they have given the capital structure. 2 situations they have given here, sir. Rupees in crores. See, if you look at the capital structure, sir, equity share capital reserves, same data. Same data. The difference is only in the loan funds. See, when they have asked the maximum number of shares to be bought back, you need to apply 3 tests. Resource test, shares outstanding test, they are same. So when the loan funds are different, debt equity ratio test will change. So the major focus is on the debt equity ratio test. Now in this question, sir, this company wants to buy back the shares at 30 rupees per share. And they are asking us to calculate the maximum permissible number of shares that can be bought back in both the situations. When the loan funds are 3,200, when the loan funds are 6,000 crores, what is the maximum number of shares a company can buy back? They are also asking this. Okay, now let us apply here 3 tests. So here, determination of maximum number of shares to be bought back when the loan funds are 3,200, when the loan funds are 6,000 crores. First, shares outstanding test. Shares outstanding test says the maximum number of equity shares to be bought back cannot exceed 25% of the total paid up equity share capital of that financial year. What are the total equity shares of the company? 1,200 crores total equity share capital. Number of equity shares 120 crores. So 120 into 25%, 30 crores. That is the maximum number of shares a company can bought back. 30. So test 1 done. Test 2 resource test, which says the maximum amount we can use for buyback is 25% of the total paid up share capital plus free reserves. What is the total paid up capital plus free reserves? 1,200 plus free reserves. General reserve including securities premium we need to consider. Infrastructure development reserve is not a free reserve. So therefore I think this one is the free reserves portion. So 1,200 plus 1,080 plus 400 plus 200. So 2,880 into 25%. 720. So maximum amount we can use for buyback is 720 crores, sir. Say this 720 as per resource test. So if I can use 720 crores and I am buying each share at 30, so what is the maximum number of shares I can buy back? 720 divided by 30, 24 crores shares. So this is also same. Irrespective of your loan fund, sir, the number of shares to be bought back as per outstanding test, resource test, it will be same. And the last one is debt equity ratio test, which is very, very important. Now come to debt equity ratio test, sir. If your loan funds are 3,200, first, how it will be? See, first, the debt is 3,200, sir. Loan is nothing but debt. The equity to be maintained is exactly half, 2:1. So that means 1,600 we need to maintain after buyback to make sure that the debt equity ratio is intact, 2:1 ratio. What is the present equity? 2,880. Say this one. Present equity. Equity means paid up capital plus free reserves including securities premium. This is the present equity. That is 2,880. 2,880. Equity to be maintained after buyback 1,600. So how much reduction in equity is possible? 2,880 minus 1,600. 1,280. But make sure that from the present equity, first we need to transfer the amount to CRR because there is a legal obligation. Whenever there is a buyback by using free reserves or securities premium, to the extent of the nominal value of shares so bought back must be transferred from free reserves to CRR. So this equity includes free reserves. So therefore from this equity, first I need to transfer the amount to CRR. Then whatever the amount balance is there, that I need to compare with equity to be maintained after buyback. That gap, to that extent, I can use equity for buyback of shares as per debt equity ratio test. So therefore my present equity 2880. Now I need to find out what is the amount to be transferred from this to CRR. Once I know the amount to be transferred to CRR, I know the future equity. And if this is the future equity, what is the equity to be maintained after buyback? 1600. So therefore I can easily find out the maximum amount permitted for buyback, then divided by buyback price. Then I will get the maximum number of shares to be bought back. Understand? Present equity is how much? 2880. Correct? What is the equity to be maintained? 1600 after buyback. What is the reduction possible? Total 1280 reduction not possible. First you need to transfer the amount to CRR. Now the question is how to find out the amount to be transferred to CRR. Here there are different techniques are there, but the technique which is prescribed in ICA study material is important. You have to solve only according to this, accordingly, which is given in the study material, then only you will get the marks. Now study material says you need to frame here two equations. First equation, what is the maximum permissible amount for buyback? This is equation number 1. Equation number 2, amount to be transferred to CRR. Now see this. Here let us assume the amount to be transferred to CRR be X and the maximum permissible amount for buyback be Y. Amount to be transferred to CRR be X, maximum amount permissible for buyback is Y. Now I am framing equation number 1. Equation number 1 is maximum permissible amount for buyback. Maximum amount permissible for buyback, how you find out? Take present equity 2880 minus amount to be transferred to CRR X we assumed minus what is the minimum equity to be maintained after buyback? 1600. So therefore your present equity is 2880. From that first I need to transfer the amount to CRR minus X and I need to maintain equity 1600 after buyback. So therefore maximum permissible amount for buyback, which is Y, is equal to 2880 minus X minus 1600. That means 1280 minus X. That means Y is equal to 1280 minus X. This is equation number 1. Now come to equation number 2. Maximum amount to be transferred to CRR X. Sir, what is the maximum amount to be transferred to CRR? To the extent of the nominal value of shares so bought back. Right? Nominal value of shares to bought back. How many shares you are going to buy back? That depends upon the maximum amount permitted for buyback. Therefore, maximum permissible amount for buyback Y divided by buyback price. Then you will get the number of shares to be bought back into face value per share, which is 10 rupees. So therefore, X is equal to maximum amount permitted for buyback. That is Y we assume divided by 30 rupees. Then you will get the number of shares to be bought back into face value. You will get the nominal value of shares so bought back. So X is equal to Y divided by 30 into 10. That is 3X is equal to Y. This is equation number 2. So you have to remember these two equations. Now solve these two equations, you will get X and Y. So X is 320. That is amount to be transferred to CRR is 320. Y, the maximum amount permitted for buyback is 960. So therefore, see this. From this 2880, I need to transfer 320 to CRR. Therefore, the amount available in the equity is 2560. This is future equity. So 2560 is my future equity, but equity to be maintained is 1600. Therefore, 960 reduction is possible in the equity under debt equity ratio test. So 960 divided by 30. So 32 crore shares I can buy back. 32 crore shares I can buy back. Say this. So least of the above three is what? 24. Now come to second situation. One loan funds are 6,000 crores. Sir, when my loan funds are 6,000, when my debt is 6,000, equity to be maintained 3,000. What is the present equity? 2,880. Therefore, buyback is not permitted because reduction in equity is not possible. Therefore, not applicable, not applicable. Therefore, maximum number of shares to be bought back as per last test is nil. So therefore, nil. Therefore, nil. That means when the loan funds are 6,000 crores, the maximum number of shares to be bought back is nil. That's it. Next, in internal reconstruction, I am going to cover one important adjustment, sir, that is share surrender concept. So during the internal reconstruction scheme, if any of the existing shareholders surrender any of the shares to the company, share capital account debtor to share surrender account. Company will write share capital to share surrender account. Now this share surrender account may be utilized by the company to settle the liabilities. So here two entries will come. One is share surrender amount will be first converted into securities, either equity share capital or preference share capital. So share surrender account debtor to share capital account. Now these shares is issued to settle the liabilities. So liabilities to capital reduction account. So important. First share capital to share surrender, then share surrender to share capital, either equity or preference. Now these shares we are issuing to the debenture holders or maybe liability holders. So liabilities to capital reduction account. Sir, out of the share surrender account, whatever the balance we are not utilizing to settle the liabilities, cancel it by transferring to capital reduction account. That is, unutilized shares will be, share surrender account will be cancelled by transferring to capital reduction account. So when shares are surrendered, share capital to share surrender account. When surrendered shares are utilized to settle the liabilities, first convert the share surrender into share capital and then liabilities to capital reduction account. Then whatever the unutilized balance in the share surrender account, transfer to capital reduction account. And before share surrender, sir, generally what happens is subdivision will happen. See, with this example you see, suppose there is a company, in that company 10,000 equity shares of 100 each is there, total 10 lakhs. Now they have subdivided shares into shares of 10 each. One share is divided into 10 shares. And ask their shareholders to surrender 50% of their shares after that. Okay. And to issue 60% of the surrender shares to 15% debenture holders of 4 lakhs in full settlement of their claims. Now out of the surrendered shares, 60% of the shares, 60% of the balance, so converted into shares, and they are utilized to settle the liabilities and cancel the unutilized surrendered shares. Very simple. First, in this case, sir, subdivision happened. Whenever there is a subdivision, total share capital will not change, but the number of shares will change. So share capital to share capital. Old share capital 100, new share capital 10. Number of shares, old 10,000, new 1 lakh. Total 10 lakhs, 10 lakhs. First thing. Next is surrender happen. Existing shareholders surrender 50% of their shares. What is the entry? Share capital to share surrender account. 10 lakhs into 50%, 5 lakhs, 5 lakhs. Okay. Now, important thing. These surrendered shares are utilized to set off the liabilities. 60% of the surrendered shares are converted into shares first. So, share surrender to equity share capital. 5 lakhs into 60%, 3 lakhs, 3 lakhs. Share surrender to equity share capital. Now, these equity shares we are using to settle the debenture holders to the extent of 4 lakhs. So, for settlement of liability, debenture holders to capital reduction. So, I told you two entries. For share converting surrendered shares into share capital, one entry, and then settlement of liabilities to capital reduction, another entry. And whatever the balance unutilized in share surrender account, out of 5 lakhs, 60% used, remaining 40%, 2 lakhs will be transferred to capital reduction account. So this is how the entries will be passed for share surrender concept. Now I will cover one important question also, sir. Illustration number 7. This question is very important. In this question, if you see, this company is going for internal reconstruction, sir. First, they have done the subdivision. Shares into shares of 10 each. Actually, original shares are 10,000 equity shares of 100 each. Now, they make each share into 10 rupees. That means number of shares will be 1 lakh. Okay. After that, shareholders surrender 50% of their holding. Now, why? For which purpose they surrendered, sir? For the purpose of reissue to debenture holders and trade payables as necessary. That means out of the shares surrendered, so they will utilize to set off the debenture holders as well as trade payables. They will use to settle the liabilities. Out of the surrendered shares, 10,000 shares of 10 each converted into 12% preference shares of 100 each. Okay. And the claims of the debenture holder shall be reduced by how much? 75%. In consideration of the reduction, the debenture holder shall receive preference shares of 1 lakh which are converted out of the shares surrendered. Okay. Trade payables, claim is reduced to 50% and it is settled by issue of equity shares of 10 out of the shares surrendered. So if you observe carefully, sir, in this question what is happening? First, originally 10,000 shares of 100 each, sir. Now they make it as 1 lakh shares. Out of 1 lakh shares, sir, 50%. That means 50,000 shares surrendered, sir. Surrender. 50,000 into 10. That means 5 lakh rupees. So if you see the entries, equity share capital to share surrender 5 lakhs, 5 lakhs. Now see what happens. This share surrender is utilized to settle two things. One is debenture holders, another one is trade payables. Now debenture holders will take what? Preference shares. Preference shares. How many preference shares we will convert from share surrenders? Out of the share surrendered, 10,000 shares of 10 each shall be converted into 12% preference shares. So therefore, from share surrender account, 10,000 shares of 10 is converted into 12% preference share capital, 1 lakh. This preference share capital we are going to issue to debenture holders. Now debenture holders ready to sacrifice 75% of the claims after taking this surrendered shares, preference shares. So therefore, debentures, see this, 75%, 12% debentures, interest, both will be transferred to capital reduction account to the extent of 75%. I told now, surrendered shares are utilized to settle the liabilities, 2 entries. First, share surrender to share capital. Here, out of the share surrendered, we have transferred to preference share capital 1 lakh. And by taking this 1 lakh, what is the liability settled? Liability account debtor to capital reduction account. 75% of the claims of the debenture holders was settled in the debentures amount as well as interest belongs to them. So this is very important. And next, trade payables. If you look at the question, trade payables are settled by issue of equity shares. For what amount? First, their claims are reduced to 50%. Actually, if you look at the trade payables, sir, trade payables is 72,000. 50% they were reduced. That means 36,000. So company will convert the share surrender into equity share capital to the extent of 36,000, because this equity share capital we are going to issue to trade payables. See this. So to the extent we settled trade payables to capital reduction account 36. So first we convert the share surrendered into share capital, then settle the liabilities, trade payables to capital reduction account. Okay. So therefore in this question, share surrender account 5 lakhs converted into preference share capital, which is used to settle 75% of the debenture holders claim. Share surrender converted into 36,000 equity share capital, which is used to settle the trade payables. And remaining balance cancelled, which is transferred to capital reduction account. So very good sum, this question. Kindly observe this question, sir. That's it.